Last year, researchers found that 73% of American homeowners regret buying their properties. For millennials and Gen Z, that number reaches nearly 90%. For millions of people, the defining achievement of their lives quickly turns to dust. We are constantly told that owning the land you live on is the ultimate marker of success. You work hard, you save up, you sign the papers, and you finally have a permanent place to call yours. But the math inside those papers tells a different story. The modern mortgage process is a carefully engineered mechanism designed to extract wealth from average buyers and trap them in an endless cycle of debt. Your bank makes billions of dollars in pure profit from this specific cycle. They rely on the simple fact that most buyers will never look past the top-line numbers of their contract. Your largest financial risk sits quietly inside the most celebrated and trusted transaction of your life. Let's follow a financially responsible young couple doing everything right. They cut back on nice meals, take extra shifts, and finally make a down payment on their first home, locking in a standard 30-year mortgage with absolute optimism. Life quickly complicates the math. Raising kids drains the bank account, the windows get broken, property taxes climb higher every year, and the cost of basic groceries and healthcare aggressively outpaces whatever small raises they get at work. Eventually, they need a change. Maybe a new baby arrives, or an exciting job offer pulls them across the country. So they put the house on the market expecting a massive payout. This happens right around year 13, which is the exact national average duration Americans stay in one home. But when the sale closes, they crunch the numbers and realize they are walking away with zero profit. Even after more than a decade of steady monthly payments, they discover the bank still technically owns almost the entire property. After 13 years of steady payments, they realize they've been stuck on a financial treadmill, liquidating their time into bank profit while their own net worth remains stagnant. To understand how a couple walks away with nothing after 13 years, we have to look at the math. Most people assume that borrowing $100,000 at a 10% interest rate means they will eventually pay the bank $110,000. That logic is entirely wrong. Over a full 30-year term, paying off that exact loan will actually cost you over $300,000. You end up paying 3 times the original price of the home. This flowchart illustrates exactly how banks extract that cash through a mechanism called amortization. Your single monthly payment is secretly divided into 2 highly unequal parts. A massive volume of your cash dumps into an interest bucket, while a tiny trickle drips into a principal bucket. Because that principal bucket barely fills up, the bank applies that 10% interest rate to a massive remaining loan balance every single year. By year 10, the interest bucket has poured tens of thousands of dollars straight into a bank vault, while your actual debt for the property has barely moved. For the first 15 years of a mortgage, you are paying an exorbitant rental fee directly to the bank under the disguise of home ownership. Look at this bar chart tracking that same $100,000 home purchase. If you decide to sell at the typical 13-year mark, you have already made over 150 payments, but your remaining debt to the bank only shrinks down to $86,000. If you manage to sell the house for exactly what you paid, you only hold $14,000 in actual equity, and that tiny sliver is instantly eaten alive by real estate commissions, closing costs, and inevitable repairs, dropping your actual payout to practically zero. Now imagine the local housing market cools off and the property value drops slightly to $85,000. You still owe the bank $86,000. Before you even factor in the taxes and fees of the sale, you are entirely underwater. This sudden loss of equity forces buyers to walk away with nothing. They empty their savings just to escape the contract, or face foreclosure and are forced back into an overpriced rental market. You buy the house, pay pure interest for a decade, and sell with zero equity. You take out a new loan, and the cycle repeats. This is the exact business model banks rely on to stay rich. Mortgages are not inherently malicious. They are high-stakes financial tools. And like any powerful tool, you need strict rules of engagement to survive using them. First, cut the timeline down to a 15 or 10-year loan to drastically reduce the compound interest you pay. Second, never buy a home with zero money down. Start with at least a 20% down payment so you do not begin your journey with absolutely zero equity. Third, budget for the holistic cost of living, which includes property taxes, insurance, and maintenance. Fourth, reject the assumption that real estate values will always go up. Buy the house because you can afford it, not because you think it will make you rich. The final, most crucial role is time. You must commit to living in the property for at least 10 to 15 years. If you plan to move any earlier, you cannot outrun the steep math of the amortization schedule. Home ownership only becomes a viable path to wealth when you dictate the terms of the math, rather than blindly submitting to the bank's default settings. The tragic reality is that millions of people fall into the mortgage trap because traditional schooling never teaches us a single word about basic financial mechanics. You have to build that missing education yourself. That is exactly why we built the Alex app, a comprehensive roadmap designed specifically to teach you how to master your money. The platform curates a highly personalized growth path based on your specific goals. We show you the exact strategies you need to navigate major life milestones, preventing you from making blind, emotional choices with your wealth. Stop playing a rigged game alone. Scan the QR code on screen right now to claim 25% off an annual membership and start making financial decisions that actually serve your bottom line.